Welcome to the Radio Revenue Podcast.
We are jumping straight into the deep dive today. Our goal is to extract, the crucial financial intelligence directly from recent corporate 10K filings.
That's right. This isn't some textbook reading. Our mission here is to cut through all the noise and just deliver concise, actionable insights for, I think it's 13 specific companies.
Yeah, 13. Across tech, industrials, and the consumer sectors, we've basically synthesized hundreds of pages down to, the 4 or 6 most vital sentences for each one?
Covering their business models, key financial trends, and what it all means for you, the listener.
Think of this as the fastest way to get smart on the massive capital shifts and, the hidden operational risks that really moved the needle this past year. We're focused purely on the facts.
All right, let's unpack this stack of sources immediately. We'll start with the heavy hitters in technology, payments, and data analytics. First up, let's talk Fair Isaac Corp, or FICO. They're essentially the analytical heart of the lending industry. They make their money from that monopolistic scores segment, your classic FICO score, and their broader software solutions.
And that score segment is absolutely the engine here. Total revenues grew, a significant 16% to nearly $2 billion in fiscal 2025.
Wow, 16%.
Yeah, and that was driven heavily by their business-to-business scores. That accounted for a massive 81% of that segment's revenue. This aggressive growth, it just shows a sustained high demand for these critical lending tools.
That is phenomenal growth, but I did notice they took on some debt this year. They issued $1.5 billion in 6% senior notes maturing in 2033, and that pushed up their net interest expense by about $28 million. For an investor, does that increase cost worry you at all?
Not significantly, no. Not in this case. FICO operates with it's basically a monopoly pricing model. So while debt is expensive, the market accepts these higher costs because their core performance is just so strong.
Yeah.
But you should note, their growth is getting more and more linked to the housing and lending market. Their reliance on the 3 major consumer reporting agencies, it's grown to account for 51% of their total revenues now.
Got it. Okay, from lending data to the backbone of global transactions, let's do Visa.
Yeah.
They're the global payments tech facilitator. They've got their huge network, and they're aggressively building out what they call their Visa as a service stack.
Which is really just using AI and APIs for things like authentication and risk management. And that network, it's still incredibly resilient. Total payments and cash volume hit $17 trillion.
$17 trillion.
And processed transactions were up 10% to over 257 billion. That's a great sign of network usage.
It is, but here's a number that made my jaw drop. Client incentives.
Yeah.
The money Visa pays to banks to drive volume. It jumped to $15.8 billion. Why are they suddenly spending so much more just to keep the business flowing? Is that competitive pressure?
It's a mix of competition and proactive defense. They acquired a company called FeatureSpace for almost $1 billion to bolster their AI fraud prevention. That's a clear move to maintain network dominance.
Right.
But that huge spike in incentives, that's likely a defensive play against regulatory headwinds. A district court just vacated the debit interchange fee rule, which governs how much they can charge. So that introduces real volatility.
Fascinating. Okay, next up is Qualcomm, the foundational tech leader, driving intelligent computing with platforms like Snapdragon for on-device AI.
And Qualcomm's product sales segment, QCT, is just soaring. Revenues rose to $37.7 billion in 2025. That's up from $32.6 billion the year before.
So strong demand.
Very strong. It validates their platform tech in smartphones and PCs. They're clearly positioning themselves for this massive AI cycle shift.
They're definitely putting their money where their mouth is. I saw their SG&A expenses jump by $351 million.
Yeah, and a big chunk of that, $231 million, was just for sales and marketing for the diversification initiatives.
Is that a wise investment, or is that just mandatory spending to keep up with the competition in the on-device AI race?
Well, it's mandatory.
Yeah.
Absolutely. They have to invest heavily to establish dominance in this shift to mobile AI. On the bright side, their bottom line got a little help from a $140 million decrease in other expenses. Lower restructuring charges, no big class action settlement like in 2024.
And the risk?
The long-term risk is still their licensing revenue. That's always exposed to negotiations and, potentially unfavorable court rulings.
So if Qualcomm is making the chips for AI, let's look at who builds the physical parts that enable it. Skyworks Solutions.
SWKS, right? They make integrated circuit products for communications electronics. And Skyworks is Well, they're struggling to reverse recent trends.
I saw that.
It's a key indicator of continued weakness in the broader consumer electronics market. Their net revenue declined another 2.2% in 2025, and that's after a much steeper, 12.5% drop in 2024.
So a 2-year slide. They're very reliant on the classic consumer cycle, right?
Exactly. They say it themselves. They rely heavily on those seasonal peaks in the first and fourth quarters. The second half of the year when everyone's making new gadgets for the holidays.
So their success really just depends on finally getting that big seasonal surge this year.
That and mitigating the disruption risks that come with any M&A strategy they might be looking at.
Okay, so if consumer connectivity hardware is struggling, let's see where the money is actually going. TE connectivity.
TL. Now, this is the industrial tech giant, the ultimate picks and shovels play for digital infrastructure. And they are absolutely thriving because of the AI build-out.
How much?
Their industrial solutions segment saw net sales growth of almost 24%. And here's the key takeaway. They reported a stunning 72.6% organic net sales increase in their digital data networks market.
Wow, 72.6% organic growth is a jaw-dropping number.
It is. It's almost all attributable to growth in AI and cloud applications. It shows it right at the center of this huge infrastructure construction.
So they're booming.
They are, but industrial demand is still uneven. On the flip side, their medical market saw a 17% decrease in net sales, mostly due to inventory corrections. And this unevenness, it justifies their decision to keep up with aggressive cost management. They spent $113 million on restructuring in 2025, and they're forecasting another $100 million for 2026.
All right, let's shift gears. Moving into industrials and core infrastructure, let's start with TransDigm Group.
TDG, the highly engineered aerospace component maker. They focus heavily on those proprietary aftermarket products.
They had a good year.
A great year. They delivered exceptional earnings growth. Net income surged to over $2 billion in 2025, pushing diluted EPS up to $32 or at 8 cents. Their whole model is built around this selective acquisition strategy. They bought another $285 million worth of companies this fiscal year.
And their structure is famously leveraged, right? That's core to their model. The 10K notes a substantial debt structure, including a trade receivable securitization facility. For the non-finance listener, what does that tell us?
It tells us they're optimizing cash flow very, very aggressively. A securitization facility just lets them borrow against future customer payments. It's a specialized tool that supports their high-leverage, high-profit model. Future growth hinges entirely on them continuing to successfully integrate those acquisitions.
Okay. Next is Rockwell Automation. Industrial automation. Connected enterprise, that's their thing.
Right. And Rockwell had a tougher year. Net income declined to $869 million in 2025. That's down from $953 million. The biggest issue was the lifecycle services segment, which recorded a pretty significant $151 million Goodwill impairment.
Let's pause on that. Goodwill impairment. In simple terms, what does it mean when a company records a charge like that?
It means that basically the value of the assets they bought in the past, the Goodwill, is now worth $161 million less than what they paid. It signals underperformance or, real difficulty integrating those past acquisitions.
And critically, they also made a big accounting change for legacy asbestos-related costs.
They did. This is important. They shifted from expensing costs as they happen to accruing for future costs.
Why does that matter to an investor?
It's a move toward transparency, driven by better data and modeling. But it will likely lead to increased reported liabilities today. It signals that this historical liability might be worse, or at least more defined, than we previously knew.
Okay, let's turn to Johnson Controls International, JCI, the global leader in building products, HVAC systems.
And JCI is in the middle of a very aggressive strategy. They're emphasizing productivity enhancements to expand margins in this high-cost environment. They've had restructuring programs in both 2025 and 2024.
Lots of charges.
Yes, $113 million and $144 million in charges, respectively. They're chasing about $80 million in annualized cost savings by the end of fiscal 2026.
Does that consistent restructuring cost suggest they're just struggling to hit baseline margins?
It signals a strong commitment to improving their operating leverage. And their focus on sustainable building solutions and their big backlog, it positions them well for all the mandated ESG spending. The challenge is managing current material costs and also dealing with these long-term legacy liabilities. Their asbestos claims could extend all the way to 2068.
Wow. Okay, our last stable infrastructure play is the regulated gas utility, ATMOS Energy Corp.
ATUS. And just as you'd expect for a regulated utility, their earnings confirm the success of their strategy, which is spend capital, then get rate adjustments.
Simple as that.
Pretty much. Net income increased significantly to almost $1.2 billion in 2025. That drove EPS to $7.46, and it's attributed directly to positive rate outcomes from their spending on safety and reliability.
So their model is just spend on infrastructure, then ask the regulator for a rate hike to recover that spending plus a return.
That's it exactly. They had several successful rate cases in 2025, totaling over $53 million in increased annual income, and they've been active in financing, locking in long-term capital for future projects.
Now, before we leave industrials, a quick note on Emerson Electric Co.
Yes.
Despite the scope of this deep dive, the stack of sources we were given just didn't contain any specific 10K financial data or strategic updates for Emerson. So our analysis is constrained, and we'll have to punt on that one.
That's right.
So let's move directly into the consumer side of the ledger. Let's transition to consumer businesses, starting with Walt Disney Co.
Entertainment, sports with ESPN, and experiences with the parks.
And they had a great year for income.
A massive year. Income before taxes surged 59% to $12 billion in fiscal 2025. This points to really successful, aggressive cost management and strong pricing power across the board.
So where did that 59% surge really come from? Was it the parks? Did streaming finally turn a corner?
It was broad, but the parks and sports were definitely the powerful engines. The challenge is still in the entertainment segment. Domestically, affiliate revenue actually declined 1%, driven by a 9% drop in subscribers, which they only partially offset by a 7% increase in prices. It just highlights that ongoing, painful transition from linear TV to streaming.
Next, the coffee giant, Starbucks.
Starbucks is focusing hard on unit economics right now. In the fourth quarter, they announced a major restructuring plan, part of their Back to Starbucks strategy.
So they're closing coffee houses. Is this a sign of market saturation, or are they just cutting the weak links?
It is absolutely focusing on long-term profitability and brand integrity. The coffee houses slated for closure were specifically identified as, lacking a clear path to financial performance or not fitting the brand standards. It signals a real focus on improving unit economics, even if it means some short-term costs.
Now to the protein producer, Tyson Foods.
TSN. And Tyson faced some severe challenges in 2025. Net income decreased significantly, down to $507 million from $822 million the year before.
What drove that?
It was mainly driven by compressed margins in their beef segment and a substantial $449 million increase in inventory cost.
And that beef segment took a huge hit, right?
Right.
A $343 million Goodwill impairment.
It's directly related. The impairment was specifically due to a lower than anticipated supply of market-ready cattle and higher carrying costs. So the commodity market volatility forced them to write down the paper value of that business. Investor focus is squarely on margin recovery now.
Final, in asset management, we have Franklin Resources.
Yeah, global investment management. And their net income declined to about $525 million in 2025.
I saw their total average AUM only saw a minor 1% dip.
Right, but that hides the real story. The firm experienced a critical and negative shift in their asset mix. Fixed income AUM dropped 21%, while equity AUM rose 9%.
Why does that mix shift matter so much if the total only moved 1%?
It matters entirely because of the revenue yield. The company explicitly warns that clients are moving toward lower fee products, like fixed income and ETFs, and away from their higher fee equity and alternative products. That directly hurts overall revenue. They're buying back shares, but sustaining revenue will depend on reversing that negative trend. When we synthesize all these narratives, you see this fascinating contrast in how massive capital shifts are happening today.
How so?
Well, you've got the entrenched infrastructure players, someone like TransDigm, generating exceptional earnings built on this highly levered structure, or Atmos, using rate recoveries to lock in stable returns.
That's the certainty of infrastructure and, regulatory capture. But then you have these often invisible technological bets. Qualcomm pushing on-device AI, TE connectivity surging because of the cloud build-out.
And this raises the core tension for you, the listener, and for the market as a whole. What is the greater risk today? Is it managing that operational legacy risk, like Tyson's unpredictable cattle supply causing a huge impairment? Or Rockwell's long-term asbestos accruals?
Or is the bigger risk betting massively on the next-gen tech cycles, the expensive R&D, the acquisitions needed for on-device AI, all with the backdrop of unpredictable regulatory responses that we see constantly hitting players like Visa?
Exactly. The battle between that entrenched, proven infrastructure and hyper-speed innovation, that's what dictates where capital flows. That tension is something really worth mulling over as you look at your own portfolio.
Absolutely.
It was Revenue Radio Podcast. Thank you for watching. Please like, subscribe, and hit the bell to stay updated with our latest analyses.